Continuing our financial statement lecture. We just covered the balance sheet and income statement and all that, just a review of accounting material you've probably seen before. Now we're going to get into ratio analysis or financial statement analysis, where we take the raw numbers of the financial statements, turn them into ratios so they're easier to interpret. They'll give us ways to compare across companies, to compare across time, and see if are the financial statements getting better or worse. So that's the idea behind this. So let's start by, I have an Excel spreadsheet here that has a balance sheet and an income statement for Coca-Cola. It's actually the same data you have available to you on your second assignment for this week, your financial statement analysis assignment. You're given Coke and Pepsi. We're just going to do the Coke stuff, and you have to do the Pepsi ratios on your own. That's your assignment. So and as we go through this lecture, you'll see how I got the answers for the Coke part. But we're going to start with, and before we get to all those ratios listed on the outline, with a thing called common size statements. Common size statement is just a way to real quickly look at what these numbers mean. We're going to start with the income statement. Let me scroll over here. So for example, they had 19 billion in cost of goods sold. Is that a lot? Is that a little? It's hard to kind of tell when you're just looking at a raw number. So what we do when we're creating common size statements with the income statement is we divide everything by sales. So Excel's nice in that it's not that hard to do this. I hit an equal sign here, and I'm going to do everything divided by revenues. And what I can do is just do that H5 cell divided by H5 cell, and then I'm going to put a little dollar sign in front of this 5, the second one. It's not, it's a percent sign, a dollar sign. And then when I hit enter, it should say 100% because that number divided by that cell is 1, which is 100%. But if I drag it down to the other cells, it tells me how much each of these numbers are as a percentage of sales. For example, cost of goods sold is 39%. So that means 39 cents on every dollar we sell goes to direct material and labor. And then we have 61 cents left over to pay for all our overhead. So we can track that over time. We can compare it to the industry average, things like that, to see how well are we doing maintaining our costs, our basic material costs and labor costs. Whether or not that's a good number or not, 39 cents on the dollar, depends. It's different for every industry. So what you might do is compare this against one of their competitors like Pepsi. That's what you're going to do in your assignment. You're going to say which one of them does a better job of keeping their expenses in line. Alright, let's go ahead and copy this down to the other accounts. Alright, so for starters, we looked at the top line. Let's look at the bottom line. We get to keep 19 cents of every dollar. So of every dollar we sell, 19 cents is profit to us that we get to keep. The other 81 cents is going to expenses to build each can of Coke. You can go down to each line if you want. Our selling general administratives, 38 cents on the dollar. Our operating income after paying for all our operating expenses is 26 cents. We have left over to pay for interest and taxes. We only pay 1 cent on the dollar to interest, so apparently Coke doesn't have that much debt relative to sales. They have a lot of sales. And their taxes are 6 cents on every sale. Alright, so that's called common size statements for the income statement. Alright, now we're going to look at the balance sheet and do common size statements. We don't divide by revenues over here, we divide by total assets. So I would do equals cash and equivalents divided by total assets. And again, I'm going to put my little dollar sign right in front of the 18. Turn it into a percent, sorry. 21% of our assets, that means, are in cash, liquid assets. Is that a high number or low number? It's a trade-off. It's nice to have a lot of cash, but it's also detrimental in that you don't earn anything on your cash. Your cash is a wash. It's kind of a waste. So it's good from a safety standpoint, it's bad from a return standpoint. There's that risk and return trade-off, which we'll talk about throughout the semester. We'll talk about a lot more later. I'm going to drag this down, and you can see how much of their total current assets make up 34% of their total assets. Inventories, for example, are 4%. So 4 cents of every asset you own is in inventory. You keep doing this. Get them all. Obviously, assets are 100% of total assets. 66% of your assets are in non-current assets. 32% are intangible assets. Now, that's pretty high for most businesses, but this is Coca-Cola we're talking about. They sell sugar water, and it's a really good business to be in. You get to sell something that sugar water basically costs them less than a penny to make, probably. It's all in advertising and things like that they have to convince you that their sugar water tastes better than everybody else's sugar water. But they don't need a whole lot of physical assets necessarily. They need a lot of intangible assets, things like brands and marketing, all that kind of stuff. And you see that in their balance sheet, that their largest asset is in intangible assets. Do the same on the liability side. You can see short-term borrowings make up 19% of all their assets. Let me go ahead and fill all these out real quick. One thing that's you'd look at right off the bat is how much of their company is funded by equity and how much by liabilities. Well, 38 cents of every dollar of their business is funded by the owner's money that they put in, and 62 cents they borrowed. It's called leverage. The more you borrow, the higher leveraged you are, the more risky you are. You'd like to have leverage because you'd like to have more return, but you can't get too much, or you become so risky that you go bankrupt, basically. But again, you could look at all these numbers and you could compare them to the industry average, compare them to their competitors, compare them to themselves in past years to see, are they getting more levered or not? Are they getting more risky? Are they getting less risky? You might want to look at retained earnings, for example. Coke is kind of unique in that the amount of money they've raised by stock is actually negative, because they've bought back more of their stock than they ever issued. It's called treasury stock when they buy it back. So they actually have negative 24 cents of every asset they had was from issuing stock, because they make so much money. They're a very high cash flow business that they buy back their stock. Well, they bought back more stock than they ever issued. However, 66% of their firm is funded by retained earnings. They make so much money, they pile it back into the business to grow with their own money that they made, where they don't have to go raise money through debt or equity. Well, that's considered equity, but they don't have to do it from external equity where they have to go out and raise money. Alright, I'm going to end this video here. We're going to start a new one, and so this is it for common size statements. And we're going to go look at all those different ratios we talked about, which is just going to be more of kind of this same idea where we look at, can we turn these numbers into something we can actually use, interpret. So this is a start, but we're going to go further than this. So I'll see you on the next lecture. Thanks.